Welcome to our video on how political events in the UK impact the stock market. If you're an investor or interested in understanding the relationship between politics and the stock market, this video is for you. In this guide, we'll explore how political events in the UK can influence the stock market and provide you with insights on how to navigate these dynamics. Let's get started. Political uncertainty and investor sentiment. Political events can create uncertainty, which can impact investor sentiment and, in turn, the stock market. Elections, referendums, or significant policy changes can introduce uncertainty about future economic conditions, regulations, or government stability. Investors may react by becoming more cautious, leading to increased market volatility and fluctuations in stock prices. Market reactions to elections. General elections in the UK often have a notable impact on the stock market. The outcome of elections can introduce changes in government policies, economic direction, or industry regulations. Investors closely watch election campaigns and manifestos to assess potential impacts on sectors and companies. A change in political leadership can create winners and losers within the market, leading to price movements in specific stocks or sectors. Effects of referendums and Brexit. The UK's decision to leave the European Union, known as Brexit, serves as a prominent example of how political events can impact the stock market. The uncertainty surrounding the Brexit process has affected various sectors, including financial services, manufacturing, and international trade. Currency fluctuations, changes in import/export regulations, and business investment decisions have influenced stock prices. Similar dynamics can occur with other significant referendums that may impact the UK's political and economic landscape. Relationship with economic indicators. Political events often intersect with economic indicators, creating a complex relationship with the stock market. Government policies, fiscal decisions, or legislative changes can influence economic indicators such as GDP growth, inflation rates, or interest rates. Investors monitor these indicators and adjust their portfolios accordingly. For example, an expansionary fiscal policy or infrastructure spending plans can boost certain sectors, while austerity measures or tax changes can have the opposite effect. Sector-specific impacts. Political events can have sector-specific impacts based on policy priorities or regulatory changes. For instance, energy and environment. Political decisions related to renewable energy, carbon emissions, or fossil fuel regulations can affect energy companies' stock prices. Healthcare. Government policies on healthcare funding, drug pricing, or regulatory approvals can impact pharmaceutical and healthcare-related stocks. Financial services, regulatory changes, banking reforms, or government support for the financial sector can influence stock prices of banks, insurers, and other financial institutions. Infrastructure and construction, government investment plans, public-private partnerships, or changes in infrastructure policies can affect construction and engineering companies' stock prices. The role of central banks. Political events can also influence the stock market indirectly through central bank actions. Central banks, such as the Bank of England, closely monitor political developments and adjust monetary policies accordingly. Interest rate decisions, quantitative easing measures, or market interventions can impact borrowing costs, currency values, and overall market conditions. Investors pay attention to central bank actions as they can influence stock market performance. Thank you for watching. Don't forget to subscribe and we'll see you in the next video.